Hello, everybody. Thank you for joining me in today's webinar. Today, we're going to be talking all about IRS liens and levies. But before we get to the content, I want to tell you a little bit about myself. For those of you who don't know me, my name is Vinar AR. I am a tax attorney and founder of AR Law. My expertise is in favorably resolving IRS and state tax problems. I know IRS procedural rules inside and out and how things actually work over there. Feel free to call me or email me anytime at no charge, and I'll be happy to answer any questions you might have. If you ever have a client that has a situation with the IRS and you're not quite sure what steps you need to take to help them solve it, I'm one phone call away. All you need to do is pick up the phone and dial the number on your screen. That is a special hotline specifically for accountants and attorneys to call me with their tax procedural questions. So without further ado, we will move on to today's content. So this segment is going to be about IRS tax liens and levies. Our agenda for this session is going to be first, I'm going to tell you about how tax liens work in general. Then I'm going to tell you about the things you can do to deal with tax liens. Then we're going to move on to IRS levies, and then to what you can do if your client finds themselves subject to a levy. So what is a tax lien? A tax lien is a legal claim against property, including future rights to property. A lien is a security interest. It gives the creditor a right to your property. When we're talking about tax liens, we're talking about the government, specifically the IRS. Now, the IRS gets their lien by statute. Under Section 6321, says that whenever there's an unpaid tax assessment, there is a lien granted in favor of the government. It attaches to all property or rights to property that the taxpayer acquires, including real estate, personal property, financial assets. It's there to protect the government's interest, to make sure that they get paid, and it is effective from the assessment date and continues to exist until the liability is satisfied or becomes unenforceable. Now, a lot of people confuse a tax lien with a notice of federal tax liens. Now, notice I didn't say anything about them filing anything with the county, because the way liens work is a creditor can have a lien is one thing, and a creditor can file a lien with the county is a whole other thing. So now what we're talking about is the lien that the government has, and that comes from law, and it arises automatically whenever you don't pay your taxes. Now, if you have a tax lien, the government has a choice, if they should choose to, file what's called a notice of federal tax lien. What that does is it quote-unquote perfects a lien. The way property laws work is when somebody has a lien on your property, that lien is valid between you and that person. If that person were to file the lien with the county, it puts the public on a notice of their right, and it makes the lien valid against third parties as well. So the purpose of a lien is so that the purpose of the filing of a notice of lien is so that taxpayers, other creditors, and the public in general knows that the government has an interest in this person's property. Okay, so now the importance of the filing of the lien is that it gives the IRS priority against other creditors and in bankruptcy proceedings. Generally, the way the law works is with liens, there's a saying, it says, first in time is first in right. The IRS doesn't automatically get priority over other creditors. They have to file their lien first. So if the IRS, for example, files a lien on a taxpayer's house, and there's already a mortgage on the house before the IRS filed the lien, well, the mortgage takes priority and the lien comes second. Whoever files their lien first gets priority over the other creditors. Now, there is an exception. Certain liens are quote-unquote super priority liens. One of those is property tax liens, which is not what we're talking about. That refers to real property tax. We're talking about income taxes where they file a lien on the property. So, they're different. Don't get the two confused. property taxes take precedent over your mortgage and pre-existing liens. Income tax liens do not. They're just like any other creditor. The other importance of the filing of a notice of federal tax lien is it will negatively impact your taxpayer's credit score. It is something that is picked up by the credit bureaus and will impact their score. So this is what a notice of federal tax lien looks like. You'll get one of these letters in the mail, and it's got a cover letter along with a notice. They send one to you, and they send one to the county where you live or the county where the property sits. A notice of federal tax lien can be against personal property, which is like a blanket lien that covers all property and all rights to property that you have, or it could be specific against a particular piece of real estate or other property. So when can the IRS file a notice of federal tax lien? There are 3 conditions that need to be met. The liability has to be assessed. The IRS has to send you, quote unquote, notice and demand for payment, which is the first bill they send you that says you owe money, write your check to this address. And then they have to give you 10 days to pay. And that's it. Once they send you notice and demand and put you on notice that you owe money and you have 10 days to pay, and then 10 days goes by without paying, then the IRS has the right to file a notice of federal tax lien. Now, of course, it's not custom practice for them to file a notice of federal tax lien after only 10 days, even though they could. There are considerations that need to be made before they make the determination to file a notice of federal tax lien. Just because the threshold conditions are met doesn't mean that the lien has to be filed. This is something that is at the discretion of the government. So they're going to consider, the following factors: the taxpayer's compliance history. They'll look at qualifications for determination exception. One example to this, the biggest example, is with streamlined installment agreements. If you get a taxpayer on a streamlined installment agreement, then a lien determination is not required. They also going to look at what's needed to protect the government's interest, and they'll consider if the taxpayer is able to convince them that the filing of the notice of federal tax lien will hamper collections. For example, I've had clients who were in the business of financial advisors, and if you're a financial advisor and you fall behind on your taxes and the IRS files a lien, well, you have to disclose that to your broker and to your clients, and that might cause you to lose your job. And if you lose your job, you will not be able to pay the IRS back. So if you can, link the chain and connect the dots from the lien to the IRS, not being able to get paid, then sometimes they'll avoid the filing of the tax lien if they feel like it'll hamper their own ability to collect the taxes. So how does a lien affect the taxpayer? First of all, it encumbers all of their assets, not just the assets they own at the time of the filing of the lien, but all future assets that they might acquire while the lien is in effect. It affects your credit score, and it affects your business and ability to borrow, not only in business, but also, personally, ability to borrow. Sometimes people have trouble getting mortgages, buying a house, or getting, a car, or getting business credit. There's a lot of negative implications to having a lien filed. You don't want that to happen. So that brings us to our first polling question today. Okay, so moving along, next we're going to be talking about what are the different options on how to deal with an IRS lien. If a taxpayer has a lien filed, what can they do about it? There are various different options. The first and foremost is you can request a collection due process hearing or an equivalent hearing. Basically, that gives you the right to argue the underlying debt and or collection alternatives. You can argue with the IRS that you shouldn't owe the money, or that they shouldn't have a lien for whatever reason, or that you should be given some kind of alternative. We'll talk more about that in a minute. You can also request an appeal under Section 6326. This is a different type of appeal than a CDP or an equivalent hearing. That's for erroneously filed liens. If you can argue that the lien should not have been filed, then you can potentially get it removed under 6326. Or you can obtain or request one of the 5 types of relief from liens. First is a release of lien, then is what's known as a discharge of lien. Alternatively, you can get a subordination of a lien or a certificate of non-attachment, or you can get the withdrawal of a notice of federal tax lien. Those are all the different options, and we're going to go through them all one by one so you guys understand what they all mean. First and foremost is a collection due process hearing. This is my favorite tool in my IRS tax resolution toolbox. The reason it's my favorite tool is because it gives you a lot of options on what you can do, and you're not limited as far as the discretion and the subject matter of the case. There are very limited circumstances where you have a right to file a collection due process hearing. There's actually only 2. It's within 30 days after the filing of a notice of federal tax lien, you have a right to file for a CDP hearing under Section 6320, or within 30 days of receiving a final notice of intent to levy, gives you a right to file a collection due process hearing under Section 6330 of the Internal Revenue Code. So if either of those 2 triggering events happen, you get the right within 30 days to file for a collection due process hearing. Now, if you miss the 30-day deadline, there's a similar type of hearing called an equivalent hearing, and they give you 2 years to file that. So they give you a lot longer time if you request an equivalent hearing versus a collection due process hearing. There are important distinctions between the 2. The biggest one is that with an equivalent hearing, the IRS is not required to stop trying to collect the debt while your hearing is pending. With a collection due process hearing, the IRS is not allowed to take any collection actions until the hearing is done and you get a determination or you withdraw it. If you do an equivalent hearing, they are still allowed to collect, although oftentimes they don't. Usually as a matter of informal policy, unless there's extenuating circumstances, they'll kind of leave you alone and let you have your equivalent hearing, even though they have the right to continue to levy and collect. Now, when you have a collection due process hearing, the way you request it is you get a form with the notice of federal tax lien. It's called the form 12153. You fill it out, you send it in, they forward your request to the Office of Appeals, and then eventually you'll get a hearing date from your appeals officer, and then you can do any of the following things. You can argue against the validity of the underlying debt. You can argue basically that you shouldn't owe the money, therefore they should not have filed a lien. However, to do that, you can't have already been given a prior opportunity to argue the debt. This kind of gets tricky, the prior opportunity rules and the jurisdiction rules on CDP, but, oftentimes you can argue you don't owe the money. You can argue that the notice of federal tax lien should not have been filed because they made an invalid determination. You qualified for one of the exceptions. You can request a discharge, a release, or withdrawal of the lien, or you can ask for collection alternatives, and that have nothing to do with the lien at all. You can ask for an installment agreement, offer and compromise, penalty abatement, innocent spouse relief. Pretty much you can ask for anything under the sun to resolve your tax problem in a collection due process hearing. That's why I like to use them so much. In other types of appeals, they're usually single issue that appeals is allowed to consider. That is not the case with CDPs. You can ask for any possible resolution. And then at the end of your CDP hearing, the appeals office will issue what's called a notice of determination, and that gives you 30 days to actually go to tax court and argue the case further in front of the court, and there's still no collections. Now, another difference with equivalent hearings and CDP hearings is you don't get the right to go to tax court at the end of an equivalent hearing, only at the end of a CDP hearing. Now, another option, if you have a lien filed and you believe that it was filed erroneously, you have a right to file an appeal under 6326. Now, what it means for an erroneous lien filing means one of the following conditions must be present. Either the tax liability was paid or otherwise satisfied before the lien was issued. You can argue that the liability was assessed in violation of the deficiency procedures. Basically, what that refers to is if the IRS wants to assess additional tax against you, there's certain procedures that they must follow, certain notifications they must send. And if they violate those procedures, then you can argue that the lien filing was made in error in violation of, the deficiency procedures. Or if they file if they assess the liability while you're in bankruptcy and in violation of a bankruptcy stay, or if the debts were expired before the lien was filed. Those are the conditions for an erroneously filed lien. I'm going to be honest with you, I've never come across an erroneously filed lien appeal in my practice. It is rare for the IRS to make mistakes like this, but mistakes do happen. I'm not going to say it doesn't happen. It's important that you understand. The limitations on the appeal is that you cannot use it to challenge the underlying debt. You can't argue against the validity of the amount of taxes. You can't argue for collection alternatives. And there's a time limit. It has to be filed within 1 year of you discovering the lien filing. Not when it was filed, but when you discovered it. And then when you make a request for an erroneously filed lien, because these are important and lien has, some irreversible consequences sometimes, if they do it in error, it's going to cause a lot of harm to the taxpayer potentially. So they tend to handle these appeals very quickly. Now, moving on to another option as far as dealing with liens, is we're going to talk about how to get a lien released. Okay, so there are 5 things that would give you a right to get a lien release. Either you fully paid the taxes, or you otherwise satisfy the taxes by, some adjustment being made or some abatement being made, or the debt becomes unenforceable otherwise, or the IRS accepts an offer in compromise, or the collection statute of expirations expires. What I mean by that is the IRS generally has 10 years to get their money, and after 10 years the debt expires and they will release the lien. Now again, it's not easy to get a lien released. You have to just basically not owe the money anymore. As long as you owe the money, the lien exists. The reason for that is because when we're talking about the issuance of a lien release, we're talking about actually extinguishing the statutory lien that I talked about earlier. This is not just relating to the notice of federal tax lien. This actually gets rid of the lien itself. And remember, anytime you owe the IRS money and you haven't paid, they automatically have a lien. So in order to get rid of that automatic lien, you have to not owe them any money anymore. It's the only way. Okay? There's 2 ways that they can release a lien. One is they issue a certificate of release of federal tax lien and they send it to the county where you live in. Or the other way is an automatic release. When I showed you the example of the notice of federal tax lien earlier, if you look at it closely, you'll see that there's some language on there that says the last day for refiling the lien. The liens are usually only good as long as the CSED is in place. So when they file a lien, it'll have a date on it and says, this is the last day for refiling. If they don't refile the lien by this date, then the lien automatically releases itself. There's language on the lien that makes it self-releasing, and it says right on there, it says, note to user, this document serves as a notice of lien, and it also serves as a notice of release of lien if this date has lapsed. So it's important to know. I've had many clients who call me. They're all flustered because they're working on a mortgage, and there's a 15-year-old tax lien, and the title company says, hey, you have to get this released. And then they call all panicked because it's not easy to get the IRS to issue a notice of lien release. And in those situations, you just have to explain to them how it works, and you point them to the language and says, look, this document is a release. You already have the release because it kind of takes care of itself after the passage of time. Now, there can also be a partial lien release. Sometimes the IRS files liens jointly against 2 parties, and they can just release one party from the lien and not the other, or release a portion of the liability from the lien or a portion of the asset from the lien and not the other. This usually happens if somebody gets taxes discharged in bankruptcy, or if one person doesn't offer in compromise and the other one doesn't, or if there's an innocent spouse, or, we're usually talking about husband and wife when we're talking about these partial liens because, it's a joint tax, so they file a joint lien. And then if one spouse gets off the hook or if the debt otherwise gets separated, then the IRS can just do a partial release. They don't have to fully release the lien. Now, separate from a lien release is an option for a lien discharge. Now, this is different because with a release of lien, if you get one of those, it extinguishes the lien entirely. With a lien discharge, it removes the lien from a specific piece of property without getting rid of the lien with respect to all the other property owned by the taxpayer. This usually comes up when the taxpayer wants to sell some property subject to a lien. It happens all the time in the housing market when people are trying to sell a house or if they're trying to sell a business and there's an IRS tax lien, and usually there's not enough equity in the house to pay for the lien. So let's say you have a house worth $300,000, you owe a mortgage of say $240,000, and then the IRS has a lien of another $200,000. Well, you can't sell the house and pay the IRS, or you could, but nobody would buy it for that price. So you're going to have to, in order to sell the house, you would have to convince the IRS to discharge the lien. That protects the buyer so that they know that this lien is off the property. Without a discharge, a sale will never happen in that circumstance. So there are 5 different circumstances where you can get a discharge. First is if the remaining property on the lien is valued at double the amount of the debt plus other priority liens. So you can get the IRS to release a particular property from your lien if you could show them that all the rest of the properties are worth at least double what you owe on them, including the tax lien and the mortgage. So the IRS is fully secured. There's no question about whether or not they're going to get paid. They don't need a lien on your mansion and your jumbo jet. You know, they can release one because the other is more than sufficient to cover the debt by at least double. So that's the first grounds. The second grounds is if you can show that the amount not less than the value of the government's interest is given to them in partial satisfaction of the debt. Now, to get a discharge on these grounds, you have to divest yourself of the property. Okay, so let me explain to you how this works. Is you have the situation where the taxpayer has a house and there's a lien that's valued at more than the value of the equity of the house and they want to sell it. What you have to do is you have to apply to the IRS to discharge the lien, and you have to convince them that they are getting the value of the lien. You have to convince them that the house is being sold for its full and fair value. You have to, give them the purchase agreement, the closing, something to substantiate the value of the house. And you say, hey, look, IRS, we know you have a lien for $250,000, but there's only $50,000 in equity. So how about we just give you the $50,000 because that's all your lien is worth. So this is, a lot of people mistakenly think that they can't sell their house when there's a tax lien unless they fully pay the lien. That is not at all true. You can, and people can and do sell their house. It just takes a little longer to close because the IRS has to sign off on the lien. And in order to do that, you have to convince them that they're being paid at least what the value, the true value of the lien, not the face amount, the value of the lien, which is equal to the amount of the equity, that their lien attaches to. Okay. Also, if the IRS has no value in the lien, sometimes, this happened a lot back when real estate, values were lower, where people were underwater with their mortgage company as it was, and the IRS lien was just totally worthless. There was just absolutely no money or no equity in the house, and you wanted to sell the house, and it was a short sale, and there's already not enough money to pay the mortgage company, so there's not even any money at all to give the IRS. Well, they'll approve the discharge in that circumstance too. They don't necessarily have to get any money, but like the other option, this has to be done with a sale. They won't just discharge the lien and let you keep the house. You can't, it doesn't work that way. This is done so that they can accommodate the sale or otherwise transfer of the property. So one of the conditions is the taxpayer has to be divested of their interest in the property after the transaction. Okay. Another option I've never actually done before is if you sell the property and then the proceeds of the sale stay in an account subject to the same claims of the IRS. So basically, rather than having a lien on the house, they have a lien on the money, and then the money stays there. With the reason I've never done it is that I can't think of any fact pattern where this would be necessary to do for a taxpayer, where they sell the house and leave the proceeds alone and leave it subject to a lien. I mean, usually the reason they're selling it is because they want the money. It's going to be used to pay off the mortgage or something else. Now, the other option is if this has to do with third-party liens. Sometimes, even if you're not the taxpayer and you don't owe the IRS any money, they can still file a lien on your house to collect on somebody else's taxes. This happens usually when there's fraudulent transfers of property or other, alter egos, nominees. There's third-party liability doctrines. So if you're a third party and there's a lien on your property, you can get it released by putting up a deposit or a bond to secure the government's interest. So you say, look, I know that he just put his house in my name, but why don't you release the lien from that house? I'll give you a lien on something else instead. That's how that works. That's another one that I've never done before, but I can tell you what I frequently do is I frequently ask for discharges to help people be able to sell their homes even when it's subject to a tax lien. Okay? And the key to doing that is you just have to show that the IRS is getting what they're due and that the property is being sold for a fair price. Now, when a property is not being sold, another option other than a discharge is what's known as a subordination of the lien. Okay, with a subordination, what that does is it doesn't remove the lien from that particular piece of property, but it allows other creditors to move ahead of the IRS in line. Remember how I said first in time is first in right? So the first person who files a lien gets first priority, and then the second person who files a lien gets second priority, and so on and so forth. But anybody in that line can give permission to somebody else to cut in front of them. Okay, this usually happens when a taxpayer wants to refinance their house. Okay, because the way it works is, let's say you have a mortgage on your house and you owe the bank, and then the IRS files a lien, and then interest rates go down like they have recently, and you don't want to pay your 5% interest rate on your mortgage anymore. You want to get a new mortgage. Now this new lender is going to come in and they're going to loan you money, and they're going to pay off the first lender, and then they're going to take a mortgage. But now what happens? The first lender gets paid off and the IRS moves to the front of the line because their lien came before this new lender. So what that new lender would do is they would require that the IRS agree to subordinate the lien, or they won't loan you the money. And when the IRS agrees to the subordination, then the new lender can come in line and come in at first, and the IRS stays at second. So that's the purpose of a subordination. That's why they're used. That's kind of how they work. The criteria for obtaining a subordination is either the IRS has to be paid an amount not less than the amount of their interest in the lien. So if there's equity in the house, you have to give them the amount of their equity so they can stay in that position. Or if you can argue that the interest of U.S. property, the interest of the U.S. government in the property will be increased by the subordination of the lien, and collection will be facilitated. This comes up a lot when somebody's refinancing for a lower rate. It's in the IRS best interest, if you owe them money, for you to have a lower house payment, because then that allows you to pay them more every month. So it's in everybody's best interest for them to subordinate the lien, because if they don't subordinate the lien, well, now you have to pay double, what your mortgage otherwise would have been, or, whatever the number is, and that leaves less money to pay the IRS. So in that scenario, when you want to do like what they call a rate and term refi, where you're not taking cash out of the house, you just want to lower your payment, the IRS will frequently, they'll almost as a matter of routine agree to the subordination because it will allow them to collect more money from you every month. Alternatively, if you can convince them that their interest will still be adequately secured, even if they subordinate, they still might subordinate. Okay, so now it's important to note with the lien subordination and the lien discharge, in none of my hypos did the taxpayer walk away with the property with any cash from the property. If you want them to subordinate a lien, or if you want to discharge, if you want to do a cash out refi in the house and you say, well, I want my equity out of the house and I want the IRS to stay in second, they're not likely to agree to that unless their second position is still, has enough equity to cover the debt. But so they're not likely, because that would harm them. That if they let you take equity out of the house and they stay in second, or if they let you sell the house and you get cash, well, they're not getting the value of their lien, and it's harming their interest, generally speaking, unless you can convince them based on the specific facts and circumstances that it is. Now, they're never required to do a subordination, but they will only do it when it's in their best interests. Now, another option for dealing with a lien is something called a certificate of non-attachment. This is what this is when the IRS, they don't change the lien, they don't subordinate, they don't release, they don't withdraw it, but they certify that a particular lien does not affect a particular piece of property. This usually comes up when somebody has a name that's the same or similar to somebody else who owes taxes at the IRS. And then, luckily I have a unique name. I'm Vinar Ayar, the only one in the entire world. But if you're Bob Smith and there's another Bob Smith 2 doors down from you and he has a tax lien, well, somebody might get confused and think that you owe the IRS money, and it might create a problem for you. If it creates a problem for you, you can request that the IRS issue you what's called a certificate of non-attachment, so they can make it clear that you're not the same Bob Smith who owes them money. Okay? It also arises, and it's also used when there's a question over whether or not a lien attaches to a particular piece of property. Sometimes these fact patterns can get really confusing. There's marriages, divorces, deaths, joint ownership, transfers, and then all these interceding events. And it's not really entirely clear if that lien is still valid against that particular piece of property, and you don't know. And you can ask the IRS and apply for a certificate of non-attachment in those circumstances where there's a genuine question over whether or not this lien is attached to a particular piece of property or not. So now, the other option for dealing with liens, the most common thing you can do for somebody is you can help them get a withdrawal of a notice of federal tax lien. Now, this is different than all the other things that we talked about, because this doesn't actually affect the lien itself or the property in which it attaches to. If you get a withdrawal of a notice of federal tax lien, all you do is you get that notice pulled from the public record. Okay? But the lien still remains intact. It still attaches to all your property. It just doesn't go on your credit. It's not disclosed to the public. It's not, all that stuff. You can request it by using a form 12277, or you can just make a written request, in a written statement. I always do it on the forms. But theoretically, if you just sent them a letter, a lot of times taxpayers who do things pro se like to write letters to the IRS. Any clear request to withdraw the notice of federal tax lien would count. And there's no deadline, and it's not mandatory. The IRS never has to grant them except if there's a violation of the bankruptcy stay. So the conditions for a notice of federal tax lien withdrawal: if you show the filing of the notice was premature, the taxpayer entered into an installment agreement which says that no lien will be filed. Okay, there's also an option where if you owe less than $25,000, you get on an installment agreement to pay them back in less than 5 years. You make your first 3 payments on time, you can get the lien withdrawn. Or you can argue that it generally would facilitate the collection of the tax. Remember my hypo of the financial planner. If there's a lien, I don't make money. Withdrawal of the lien will facilitate the collection of the tax. Lastly, you can show that the withdrawal would be in the best interest of the taxpayer and the United States. This is a catch-all designed to catch any fact pattern where you can conceivably say, even if it doesn't facilitate the collection of tax, it can be in the United States' best interest to release the lien for some other reason. I don't know any fact patterns offhand to give you, but if you can come up with anything where you can say, well, it's in the government's best interest to release the lien, and not because it will facilitate the collection of tax, well, you can ask them and they will get them withdrawn. And that brings us to our next polling question. Okay, so moving on, now we're going to talk about levies. Okay, we're done talking about liens. We're going to talk about levies. So what is a levy? It is the seizure of the taxpayer's property to satisfy a tax. It's authorized under Section 6331 of the tax code, and any property or right to property that belongs to the taxpayer on which there is a federal tax lien can be levied. There is an exception. There's certain property that's exempt from levy per the Internal Revenue Code, but other than, nominal exemptions, pretty much anything's up for grabs. IRS can take anything that they want as long as you own it and they have a lien on it, a statutory lien, not a notice of federal tax lien. There's different types of levies. There's automated levies, which are sent automatically through the computer, usually to federal contractors, federal employees, federal payment offsets, against state tax refunds. Those kind of levies are done automatically. There's a manual levy, which is prepared manually and issued by an IRS revenue officer usually. A paper levy or a systemic levy. Now, when will the IRS levy your client, or when can they levy you? If they sent you notice of demand, they gave you 10 days to pay, then they have to issue a final notice of intent to levy and notice of your right to a hearing. They have to give you 30 days to request a collection due process hearing, and at the end of those 30 days, they're allowed to levy you. Now, note that there's only two notices that they're required by law to send you. Normally, they'll send a lot more in the collection process. They'll send a whole bunch of letters when you owe them money. There's only two that they actually have to send before they start taking stuff. The notice in demand, and then a collection due process notice of intent to levy, or also known as a final notice of intent to levy and notice of your right to a hearing. Now, although that there's only two notices that are required to be filed before any levy, customarily, taxpayers are at least get 4 notices before levy. First, they get notice in demand, and then they get notice of intent to levy, which is not to be confused with the final notice of intent to levy. And then you also have to get sometimes a notice of third-party contact. Anytime the IRS intends to contact a third party concerning your debt, they have to tell you about it. And issuing a levy to a third party, i.e. a bank or to your employer, constitutes a third party contact. So before they issue a notice, they will issue a third party contact. So like I said earlier, there's a difference. There's something called a notice of intent to levy. That's what you see on your screen. This is not the notice that we're referring to when I said that there's 2 required to be filed by law. The one I was talking about is called a final notice of intent to levy. Notice this one says final notice, and it says notice of your rights to a hearing. Once you get this final notice, you have 30 days to file for request a collection due process hearing, which will generally stop any levy actions until you've had a chance to have your hearing. Now, one thing that they can levy is a bank account. Those are generally sent by mail to your bank. They become effective at the time and date that the bank gets the notice. And what happens when a bank gets a notice of levy is they will freeze your account, and then they'll hold the money for 21 days to give you a chance to get it released. And at the end of the 21 days, they give the money to the IRS. If you get a levy and there's more than enough money in the account to cover the levy, then the bank must send what's subject to the levy and not all your money, obviously. They just send what you owe. And the other thing to keep in mind is that the levy only attaches to the money that was in your account at the time they froze it. So when the bank gets a levy, they sweep your account, and then if you go to the bank that same day and make a deposit, well, that new money you deposited is not going to be swept and subject to the levy. It's only attaches to what was in the account at the moment it was processed. If there's multiple signers on the levy, the IRS can take all the money. If there's multiple account owners. If your name is on somebody's account as an account holder, a joint account between husband and wife, or parent and child, or joint account between any 2 people, a levy on one person will give the IRS a right to take all the money, not half of it. Okay. However, if you're a mere signer on the account, you're not listed as an account owner, but just have signature authority, that does not give the IRS the right to take the money in that account to collect your debt. This only applies when 2 people are named as the account holder. If they erroneously file a levy, you can file a Form 8546, which is a claim for reimbursement of bank charges, as long as you meet all the conditions. Now, an alternative to the IRS levying your bank account is that they can actually levy your wages or garnish your wages or other income. The way that works is if they issue a wage levy, then part of your wages will be sent to the IRS on a continuous and ongoing basis until you make other arrangements to pay the debt, or the amount owed is paid, or the levy is released. Now, keep in mind that when we talk about wage levies, it doesn't only apply to wages. You can be a 1099 contractor and get a wage levy issued against you, and it is valid against continuous payments if you meet the test. Basically, if you're a 1099 contractor and you have a continuous source of income, versus individual transactions, a lot of carpet guys and painters and drywallers, they're just treated as contractors, but they really just have one job. They can issue continuous levies against that. So this is what a notice of levy looks like. It'll have taxpayer information, then it'll have the information about the debt, and then the most importantly, on the bottom, it has instructions to the recipient of the notice. It's very important to carefully read the instructions and to make sure if your client gets levied that whoever receives the levy carefully follows the instructions and that they're only turning over the money that the IRS is entitled to, no more. So how much can they take on a wage levy? There is a certain amount that is exempt that is determined based on the number of dependents and your filing status for the year. There's a basic exemption for everybody. It's like $200 a week or something like that. But you can get more than that exempt if you fill out the exemption form. So your employer will get the wage levy, and there's an exemption form for you to fill out to give them the number of dependents and the information they need, and you can get more of it exempted. So how the IRS actually secures the garnishment is they'll send the wage levy to your employer along with the table for the exemptions. If you have more than one income source, they can split the exemptions or apply them to one or another. Now, there's something called a levy and something called a seizure. They're technically two different things, but they're often used interchangeably. The biggest difference is with a levy is sent to a third party who's holding your money, a bank, an employer. A seizure is when the taxpayer holds the property and they show up to your house and take your car. That's called a seizure. They don't issue a notice of levy directly to you if you're in the possession of your own property. Now, to get levy released, you should contact the IRS immediately if there's a levy. And you can ask for a release. You have to come up with grounds for a release. We'll go over some of those shortly. And if the IRS denies your request, you have a right to file an appeal. Also, make sure that in addition to asking for a release of levy, ask that the funds be returned. Those are two different things. They can release the levy and give you the money back, or they can release the levy and keep the money. Usually they'll keep the money, but it doesn't hurt to ask for a release. And if they release the levy, obviously it doesn't mean that you don't have to pay the IRS anymore. It just means that they're releasing that one source. So there are 6 different circumstances in which the IRS is supposed to release a levy. You have to establish that you meet one of these 6 circumstances in order to get your levy successfully released. First, you can pay the amount in full. Obviously, if you full pay the taxes, they're supposed to release a levy. Or if the CSED expires, the collection period expiration date, the IRS runs out of time to collect, just like with a lien, they would have to release the levy as well. If you can show that releasing the levy will help the taxpayer pay their taxes, the example the IRS uses for this circumstance is if they levy your brokerage account and there's money in there, but you need the money so that you can exercise options, and then once you exercise the options, you'll have more money. Then they're supposed to leave you with the money so that you can exercise your options and get more money and then pay them. If you enter into an installment agreement, and the installment agreement doesn't allow for the levy to continue, most of them don't, the installment agreement is an alternative to a levy, then they will release the levy. The biggest reason, and the one that we rely on the most, is anybody can get a levy released at any time as long as you can show that it's creating a hardship. Like, for example, with an installment agreement, if you want to get a levy released on the grounds of an installment agreement, you have to get all your taxes filed first because you have to qualify for the installment agreement. What if you don't have your taxes done and they're levying your bank statements and there's just not enough money to put food on the table? Then you can ask that they release the levy because it's causing a hardship. A hardship is defined as the inability to meet your reasonable basic living expenses. And the way you establish a hardship is by using a Form 433 and making a financial disclosure to the IRS. If you're dealing with automated collections, you use the Form 433F. You fill out the form that discloses the taxpayer's assets, their income, and their expenses. And then you go over it. You call the IRS collections. You go over it with them over the phone. And if their expenses are equal to or greater than the amount of their income, then they must release the levy in full. If the expenses are less than the income, then they can do a partial release. So let's say a taxpayer has absolutely no ability to pay, then the IRS must do a full release of the levy. But let's say the taxpayer, according to your financial analysis, has the ability to pay $50 a month, but the levy is more than $50 a month. Well, then the IRS would have to partially release the levy to the extent that it's creating a hardship. Now, keep in mind that economic hardship is only available to individuals. Companies do not have living expenses. So when we talk about economic hardship, we're only talking about individuals. Okay. However, with companies, if you can show that the levy is needed to pay the wages and will create a hardship for other people, then you can still get the levy released. A lot of times, clients will be levied and then they don't have any money to cover payroll. Well, then I can show that the levy is creating a hardship, not for the taxpayer, but for the employees who are now not going to get paid. And then the IRS would release the levy to the extent it's needed to cover the payroll, for example. And then the sixth and final way to get a levy release is if you can show that the value of the property being levied is more than the amount owed, and that releasing the levy will not hinder the IRS's attempts or ability to collect the remaining amount owed. So that's it with levy releases, and that brings us to our third and final polling question. So thank you everybody for joining me in today's webinar. Hopefully you found it informative and you learned a lot about how IRS liens and levies work. Don't forget that if you guys have any questions about today's content or about anything else related to tax resolution, please don't hesitate to call me. I have a hotline set up just for accountants and attorneys to call my office and ask us questions about how to solve IRS problems. The number's on your screen. Keep it handy. You never know when you might need it. Thanks again for joining us.